Adam.
Good morning, everybody, and welcome to this webinar, Distressed M&A and Insurance-Backed Solutions. Thank you for joining. We're just going to hold for a minute or two for anyone experiencing any connection issues, if that's all right. Right, good morning, good afternoon and good evening to those participants around the globe joining us today. I hope you find this webinar useful. My special thanks do go to Tim Martin from Ryan Specialty Group, Dawn Bomer and Rob Brown from Iceland Risk, and Richard Wimborne from Themis Underwriting for agreeing to participate today as panelists. And I would also like to mention Vince Barker of Partridge Advisory, a firm that we partner with in Australasia on M&A related insurances and other financial lines, for his collaboration. Before we dive into the subject matter, a few housekeeping points. We will have a Q&A session at the end. Please send through your questions that you may have using the chat facility, and we will do our very best to answer all questions. But in the event that we do run out of time, all questions will be collated and the answers will be circulated to everyone via email for reference. Finally, two just important things to note. These really are not panacea products, and insurance is not there to make a bad deal happen. Since March, we have seen so many high-profile casualties as companies continue to struggle with the economic downturn and subsequent lag created by coronavirus, and we expect these to continue for the foreseeable future. A significant distinguishing factor between the financial crisis of 2008 and the current situation is that the impact of 2008 was very much confined to the financial institution sector. With this pandemic, we are very much all in this together. I found a quote from Rahm Emanuel, an American senator: "Never let a serious crisis go to waste." And what I mean by that, it's an opportunity to do things you think you could not do before. I think that's a slight extension to previous quotes cited by Winston Churchill. The M&A insurance market in 2008 was not as advanced as it is now, and some of the subject matter that we are going to cover this morning hadn't been created. Without further ado, I will now hand over to Tim Martin, who will talk us through traditional warranty and indemnity insurance and how solutions have been adapted to address a distressed or accelerated M&A process. Over to you, Tim, to give us your perspective on the insurance market in the current climate.
Thank you, Adam, and thank you everyone for taking the time to dial in this morning. As Adam said, I'm going to be talking about warranty and indemnity insurance, and then the other panelists will talk about tax and contingent risk. So as Adam said, I think the good news is that the M&A insurance market is a lot more sophisticated today than it was back in the financial crisis of 2008. There's a lot more people involved in the insurance sector for M&A products, both on the broking side and underwriting, and there's a greater awareness and utilization of those products. Just in terms of statistics, in the UK, we would said in 2008, 6% of deals done had some form of M&A insurance, principally W&I, attached to them. That figure had grown in 2019 to 40%. So it really is part of the transaction landscape now. So there has been that heavy uptake of M&A insurance products. We know private equity are big users of the product and have been big advocates of using M&A insurance, particularly in their seller-led auction processes that they've been doing over the last few years. It's also very prominent and prevalent in the real estate sector, and again in infrastructure and renewable deals. So what's happening now is probably a little bit early to tell. We've only just sort of started the journey in terms of, I guess, this new economic and pandemic crisis that we're going through. But what we did see in March and April is a significant drop in terms of submissions, so that's transactions where quotes for insurance were required in both March and April. So that was down 50% from the same time in 2019. So just a huge calming of M&A activity that we've seen so far. We then also, for deals we had in underwriting, those largely fell into two buckets. We had about 50% of the deals again go on hold. The deals that were put on hold were largely the deals that are being heavily impacted by the lockdown and the wider COVID issues. And the deals that continue to transact are those that probably had a lighter exposure. So lots of renewable deals still got done in that sense. And it sort of feels a little bit like people are just somewhat holding their breath, just waiting to see, what's going to happen next. What will be the timeline for any recovery? What will that recovery be like? We've all seen the press articles talking about either a V-shaped recovery, a U-shaped recovery, or a W-type recovery. I think everyone is just somewhat waiting to see what will happen. But as we said earlier, there are deals still happening, particularly in areas that are less impacted by the lockdown. So I've got a list here of just some of the deals we've done in the last 6 weeks. It's not exhaustive, but it just gives you a flavor of the sorts of deals we've been doing. So we've done a large tech deal focused on cloud storage and networking. We've done a European mid-market cloud hosting and connectivity business, a medium-sized compliance regulatory advisory firm for the investment management sector. We've done a 20-turbine Scottish wind farm project, as well as other renewable deals in Europe. We've done a loan portfolio, secured over 70+ commercial shipping vessels, a medium-sized outsourced accounting and payroll solutions provider, an insurance broking business based in Ireland, a medical devices business, a food hygiene and safety business, and then deals in the real estate sector, principally with assets focused around logistics and distribution centers. I think what we haven't seen yet, which just sort of shows you kind of where we are in the cycle, is we haven't seen a huge raft of distressed deals coming to market, but I think those are to follow, and that's sort of the purpose, I guess, of this webinar today, is to talk about how insurance can help in those situations. And then I think what I would also just sort of temper that with is, at some point there will be a recovery, and again, as we've seen in Europe over the last 5-10 years, private equity is a large part of the European deal-making environment, and so we're already seeing some of the bigger funds starting to ramp up. We're seeing a few more deals coming in from KKR, so I think you will see those private equity funds wanting to take advantage of any discounts that they perceive they can acquire. So back to Adam's point of, don't let a good crisis, impinge on your deal making. So how's that kind of following through to the actual deals itself? I think we've all probably now heard the phrase EBITDA with a C on the end for COVID, and I think that's right. I think buyers now are looking to try and model what the future looks like, and they're being cautious, and I think they're trying to add as many variables as they can and give, when they're looking at a best case, a worst case, and a medium case scenario, they're trying to give themselves as much headroom to see how those will all pan out in the future. We're also seeing, buyers have more bargaining power now that they're at this sort of at the table. So again, we're seeing buyers who perhaps are struggling with valuation, looking for bigger price reductions at the final hurdle. We've certainly seen deals with that where everything goes quiet for 36 hours, then the deal's back on, but the headline value has come down. Linked to that as well is just buyers, I think, using deferred consideration more than we've seen in the past. So not so much in the traditional sense of a small slice of deferred consideration at the end of an earn-out period in a traditional private equity deal. We're seeing it more now in terms of an immediate pegging of deferred consideration over the medium term of 3, 6, 9 months as the target company achieves commercial milestones. They're pegging a little bit more consideration to that future trading risk so that the buyer has a bit more certainty around what they're acquiring. In terms of blanket COVID exclusions, most insurers aren't mandating a blanket exclusion on every single deal. I think that sort of speaks to Adam's point earlier about the level of sophistication we're seeing in the market now. But where you do have a target business that is impacted by COVID, you are seeing underwriters put exclusions in for that. So examples are, we haven't had any COVID exclusions in some of the real estate deals we've done. We haven't had it in some of the renewable deals we're doing, particularly for fully operational, solar panel farms and wind farms, but we are having it on more operational based deals. But where there are exclusions, they're not simply a blanket exclusion saying anything related to COVID at all is excluded. They're a bit more focused, they're a bit more bullet pointed in what you're seeing. So typically they'll be talking around internal employment issues, external recovery of third-party book debts, and then supply chain interruption issues, both in terms of how that impacts on the target's ability to trade and how it impacts on the target's ability to service its own clients. In terms of the M&A process itself, I think we've all seen over the last few years, pressure on buyers to transact very quickly. I think that will continue as distressed deals come through, but the issue that we'll have to wrestle with now more is how do buyers deal with making sure they've got as much up-to-date information as possible, particularly for businesses that have been impacted by the lockdown, perhaps where there's been staff, not on site. And I think the way we're seeing buyers dealing with that is asking for more time with management, more conference calls where face-to-face meetings can't be done, but a lot more involvement of the management team giving trading updates, giving briefing updates, and not just simply a seller's team pointing to a data room and saying the information is in there. So you're seeing much more time with management, and we're also seeing a shift in transaction structures. We're seeing less locked box deals now, and we're seeing a move back to completion accounts, particularly for inventory heavy targets, where I think just given the business interruptions we've seen, a locked box count can leave a buyer somewhat unsure as to what they're acquiring. So we're seeing a shift back to completion accounts, really across the board, not just limited to the real estate sector like it was perhaps a year or so ago. So that's kind of the state of where we are in the market. It's probably now good to talk about sort of distressed deals and how insurance can help with those. Synthetic warranties is the sort of the newest concept and product out there. But a quick step back is what you'll hear the insurance market refer to as the £1 liability cap. All that means is insurers are now comfortable over the last few years, certainly since the financial crisis of 2008, of allowing sellers to transact the deal in the ordinary course, give the warranty pack in the transaction documents, either in the SPA or the warranty deed, in the ordinary course, but knowing that a buyer-side policy is going to be placed, the buyer will allow the sellers to contractually cap their liability for warranty breaches and for a tax covenant breach to £1. And I think that will be more and more useful now for distressed deals, particularly where you've got management in the target company rolling over, but management aren't taking any cash out of that deal. So in that sense, it would be problematic to ask management teams to stand behind the warranty pack economically because there's no upside for them. So that £1 liability cap is going to help get some of these distressed deals over the line. And that's been there for a while, but it kind of comes into its own a bit more in distressed deals. But if that's not the case, or if the management team, aren't available, or if you've got a seller that is just simply refusing to engage in any form of warranty pack negotiation, the next step is then to start talking about synthetic warranty packs. So what we mean by synthetic warranty pack is, rather than the warranties being set out in the transaction documents as you'd customarily see, you don't do that. You don't involve the seller in that part of the transaction process. And instead, you put the warranty pack and any tax covenant directly in the insurance policy that's issued to the buyer. So it's a buyer-side policy with all the warranties and tax covenants set out in the policy itself. Now that is, as Adam said, that is a newer innovation in the market. Just talks to the level of sophistication that we now have. The last deal I did that on was last year. It was for a REIT real estate deal where you had the sellers who were a REIT selling to a competitor. They were all in the social housing sector, and there wasn't room for two social housing REITs in the sector, so the seller was happy to sell up, but because the seller was selling to a trade buyer, it just shut down any talk straight away of entertaining a warranty pack. But the REIT's a cautious buyer, and it likes to have W&I on all its assets it's acquired. So the buyer and the buyer's lawyers put their heads together, came up with a slightly narrower warranty pack, to be fair, than you'd have had it been negotiated at arm's length with the third party. And they came to the market, and we insured that at RSG. So it can be done. It does present its own challenges. I think the first challenge is who negotiates the warranty pack, who does the first draft of the warranty pack, and just setting out right from the outset realistic expectations as to what can and can't be covered under a warranty pack. And I guess we would just take a step back and say, warranty indemnity insurance is a very useful tool, but it's designed to give a buyer comfort around the assets and liabilities it's acquiring at the time of the transaction. It's not there to give you commercial trading comfort going forward. So to be honest, in any warranty indemnity policy, you wouldn't really expect there to be warranties talking about future collection of book debts, future performance as against budgets. Those really aren't warranties that the insurance market likes to insure, and you won't see those in distressed deals either. So you've got the hurdle of negotiating the warranty pack. Insurers can do that for you. Insurers have their own warranty packs that they can present, or the buyer can have a first draft as well, but we would just caution the buyer to temper that warranty pack from the outset and to be realistic, bearing in mind you're negotiating with a third party that doesn't have that embedded knowledge that the sellers have of the target business. And that kind of links into the second hurdle that generally the sellers aren't doing a line-by-line warranty review because the sellers aren't giving you that warranty pack. So the buyer is going to have to do its due diligence process, but the insurer is going to want to know the buyer is doing a full due diligence process. They're going to want to know the buyer is having good access to the management team. They may even want to see a Q&A document between the buyer and the sellers, which will help tick off some of the points that the warranty see. So it's a slightly different approach. It probably isn't anything different to what the buyer would be doing in any event. It's just the buyer will be doing it in conjunction with the insurer, or feeding that information back to the insurer to make sure that the insurer is comfortable. Because in this case, all the warranties are in the policy and there's no disclosure letter provided by the seller. So the insurer is kind of pegging it all back to the due diligence reports and any Q&A process that's being done. So I think synthetic warranties are available. It is out there. We would say always get your broker involved early, speak to Adam, and then Adam will come and speak to the market, and we can all decide what can and can't be done. I think with distressed deals, it's always going to be somewhat on a case-by-case basis. There'll be some target industries where underwriters just have less appetite. I think if you are a target industry in a sector that's hugely distressed, those are the more challenging end. If you have a target company that itself is distressed, but the wider sector is faring quite well, that presents a good opportunity for insurers to look at that to see see what the buyer does in terms of its business case, to see how the buyer plans on turning that target around. So I think there's lots we can do in the distressed scenario for warranty indemnity products. There'll be lots of additional bolt-on products that both Dawn and Richard can talk to in terms of managing tax risk and managing some of the insolvency practitioner risks that may arise. But that, given the time we've got today, is a very quick canter through warranty indemnity and how it can be used on distressed deals.
Great, Tim. Well, thank you very much for that. That's very much appreciated. I'm now going to pass the baton over to Dawn, who is now going to explain and expand on how and why tax liability insurance should be considered. And she will also provide some case studies as well, which will type of put it into perspective for everybody. Dawn, if I can hand over to you.
Thanks very much, Adam, and thanks also to Tim. So Tim's taken us through the W&I and the current market, which covers unknown risks. So I will now turn to tax, and by that I mean identified tax risks, which are known to all the parties on the deal, and everyone is aware of that issue. I was the first underwriter with a tax background to join this market nearly 8 years ago, and the market always underwrote tax risks, but was quite reactive. So that innovation and sophistication that Tim's been describing in relation to W&I also applies in relation to tax, where insurers have really made significant investment in hiring experienced tax personnel to join their teams. But some of the development in the market can't be credited purely to the market. Clients and advisors have been incredibly innovative in the way they've decided to address tax and effectively remove some real headache from deals by using insurance very effectively. So we used to just see tax insurance really used often where there is low risk but very high quantum in the context of the deal, and the parties simply could not agree who takes on the risk. Frequently the seller saying, there's no issue here whatsoever, we've done nothing wrong, and the buyer and its advisors, of course, not quite agreeing with that. And what we've then seen in the last few years, predominantly led by private equity being very innovative, is we've seen it, for instance, in bids, in auction processes, where a buyer knows that there's a tax problem in the target, but doesn't want to make their bid uncompetitive in any way by requesting a price chip or a specific indemnity or an escrow. And so without even having to raise the issue with the seller and make their bid beautifully appealing, they insure that tax risk away. And so it doesn't even need to become an issue on the deal. We've also seen both corporates and private equity funds protecting their own individual management against unexpected tax risks. And that's frequently could be a private equity fund just purchasing insurance to keep its management team incentivized, knowing that they will obtain, for instance, capital gains treatment when they exit and not have to face the higher rates of income tax and national insurance. And then sellers have used tax insurance incredibly effectively in the last few years, normally by approaching the insurance market, sometimes before they even go to market with the asset, knowing there's a tax issue in that business that the buyer will raise. And to try and preserve value for themselves and avoid a price chip, they will often approach the market, insure the risk away, and again, just take that issue completely off the table. And I think what I would say is there is just a huge range of taxes across lots of different countries that are now insurable that certainly wouldn't have been back in sort of 2007, 2008. And we insure risks with a quantum of sort of £400,000 or £500,000, and that can be spread across multiple individuals on a deal, up to 100 million per risk. And we see everything in between. But generally, most of the things we insure are actually sub 20 million. But tax is one of those issues, as many advisors will understand, that just causes incredible tension on a deal. So even if the quantum is not necessarily enormous, it can just take a headache away from a process by seeking the insurance. And we've mentioned private equity quite a lot, but I think it's also worth pointing out that individuals use tax insurance now, as do, of course, corporates. Insolvency practitioners protect their own personal liability for tax by approaching just to cover themselves, and we've insured insolvency practitioners, some of whom were coming up to retirement and actually faced potentially a 10-year risk of significant tax liabilities landing on them, or one day potentially their estate. So they've bought insurance to protect themselves and their families against an unexpected HMRC inquiry. I could talk you through some of the examples that we've seen in the last year or so, just to give you an example of the types of risk that we see. We had one just before Christmas, which even pre-COVID was a very, very distressed healthcare business, and the seller was managing to sell the business, but the buyer was demanding that the seller does effectively a debt tidy up and clean up the balance sheet. And that is virtually impossible to do without some level of tax risk being created. And although there was lots and lots of advice from accountants and lawyers and QCs, ultimately this issue was a complete deal breaker, and the buyer simply would not buy the business without tax insurance. And so we insured that, and that enabled that transaction to proceed. And the clients fed back that sometimes insurance is useful, and sometimes it is just absolutely imperative in getting a deal done, and that was one of those. We also helped some individuals who didn't have significant power in a transaction where they owned some of the shares, but private equity held the majority. And due to the need for a pre-sale reorganization of the business, effectively to spin off half of the business to a different buyer, it involved some changes to the articles of association, and it caused real doubt for the individuals over whether they would face an income tax recharacterization. And the total limit for that was just under £1 million, but that was £1 million for two individuals who also just didn't fancy the idea of HMRC come knocking in 3 or 4 years' time when they think they've sold and guaranteed their sales processes and proceeds. So the private equity house agreed, because they wanted to keep management on side, they agreed to pay for a policy to guarantee and lock in that critical capital gains treatment for the individuals. And that just helped the deal proceed, because management, of course, as they normally are, were absolutely critical. And the buyer, the new PE house, was trying to really show they were trying to run a really conciliatory process and not upset management at all. We also helped an investor where they held an investment in a business which is in the education sector. And every single year, virtually, there was new case law as HMRC attacked the sector in varying different ways on its VAT treatment. So there were just these constantly shifting sands that the advisors and the company were always trying to keep up with, and they were looking to sell in a year or two's time. And so they bought insurance even in advance of a deal, just to take that issue off the table, because they knew it's an issue that affects the entire sector, and every single buyer would either seek some form of escrow or price chip, or as a minimum an indemnity for the point. So that just, again, the feedback on that was it would certainly assist when they did sell, but it also just took a headache away, and it's sort of sleep easy cover for the team, and particularly for the tax director on that deal. I think I think people might be quite pleasantly surprised by the cost now of tax insurance, because I remember when I first joined, a lot of advisors said, oh, well, it's great, but it costs 30% of the sum insured, and perhaps not so good for us, but certainly very good for clients, is it's now normally most risks, and obviously they're all different and bespoke, but tend to be between 2 and 6% of the sum insured is normally the premium. So that is normally a pricing which is very appealing, to take some of the strain of these tax risks off the table. And the insurance policies cover not just the tax, but they also cover interest, penalties, and the defence costs of having to deal with the revenue, which anyone who's dealt with the revenue will know how quickly those costs can rack up. And I think it's also worth pointing out that it's not just in an M&A context that tax insurance is used. I referred earlier to insolvency practitioners, and even outside of a deal, insolvency practitioners are now insuring the market and successfully removing tax risk. We've insured some in the context of litigation where the insolvency practitioners have received damages, and there could be a tax risk in relation to the damages. So this is used in not just in an M&A context, but now is evolving into wider use. And tax has become a PR issue in a way that I never ever saw in private practice. And so for finance directors and tax directors, this is a really, really challenging issue. And we insured a risk last month on a Canadian deal where a CFO had a provision on their balance sheet and had it there for 4 years because the Canadian authorities had opened an inquiry years ago and have refused to close it, even though they've not taken any action. And of course, that's just taking value out of that business, as that provision just sits there year after year. So we released that, and we're also working on one where we're releasing funds in escrow that have been held up on one deal, but in 4 different countries. So we're now replacing that escrow and just freeing up cash, which is of course absolutely critical, particularly in this current environment. So I think tax insurance will actually only grow from here on in. I think the strength of an insurer's balance sheet in distress times such as these will only be of more value actually going forward, and as tax continues to become, and certainly will become, more and more of a PR issue, as governments will clearly have to raise their tax take. I don't think tax risk is going to minimize for businesses anytime soon. And so I would just say, as Tim said earlier, it's definitely worth, on any issue you're tackling on a deal, pick up the phone to Adam. He can access the market, which now has a really broad appetite and great specialism in it on tax, to help resolve these contentious tax points.
Dawn, can I just ask a question? Yeah, to some of the participants or the attendees who might not be familiar with the product, which has been spectacularly explained, is the actual underwriting process. So, what would you require to come up with an effective pricing for their benefit?
Yeah, sure. So what we would normally see is we would either receive typically a due diligence report, either buy side or sell side. It could be a counsel's opinion. Sometimes initially it is just an email setting out the deal and the background, and just describing the tax issue at stake, and also that advisor's view on the level of risk. And then we as insurers will analyse that issue for ourselves, see if we agree with the conclusion that advisor have produced, and then we will produce pricing. So we don't always need very formal legal advice. We can give initial views on pricing normally within 24 to 48 hours of receiving either the relevant advice, or if needs be for speed, just a quick email summarise.
Thanks very much, Adam. And also just to echo the thanks for everyone that's taken the time to dial in, and also for the presentation so far from Tim and Dawn. It's been very interesting, so much appreciated. In terms of specific risk and contingent, as you've just alluded to, Adam, the market as a whole has several names for it. There's also a growing trend of calling it special situations, which is why I put up the slide that you can be anything you want. I think what I'd suggest for the takeaway is to think of it very much like the tax insurance product. It is there to cover known risks that come out of a transaction, and you often refer back to the Donald Rumsfeld quote about your unknown unknowns and your known unknowns, etc. As Tim's very accurately described about warranty indemnity insurance, that's there to cover your unknown unknowns. But often during a deal process, where your advisors are going into a transaction, they will find known issues. If those known issues are determined in terms of quantum and time, for example, a piece of litigation, and you think it's highly likely to be lost, then obviously that's not where insurance can help. As Adam's already said, we're not there to, we're not a panacea and can't make a bad deal happen, as it were. But there is a middle ground between something that is totally unknown, which can be picked up in the W&I, and those known knowns. And that's where your specific risks, which back out those specific indemnities in an SPA commonly, where the specific risk insurance can be a tool to have in your toolbox to help facilitate the transaction. So as I say, think of it as Dawn said, on those tax policies, it's for those known risks where the quantum is high, but the risk is viewed to be remote. And so that causes a dynamic between the buyer and seller that can't be apportioned on the deal, where the seller is reluctant to take a price chip because they're very confident in the risk, and had it not been for the transaction coming along and crystallizing kind of the parties' thoughts to this risk materializing, the seller would have carried on running their business and let whatever this issue is kind of bubble along in the background. But the buyer's come along and is thinking, well, if you want 50 million or 100 million for this target business, I don't want to hand over that check, and potentially this issue, whatever it is, can crystallize, and maybe it costs me 10%, 20% of deal value. So therefore, yes, you say it's risk remote, but I'm the one that's going to be carrying the can, so I want a price chip. And it causes that dynamic, as I say, that can't be bridged. And that's where insurance can come along, ring fence that issue, and potentially take it off the table. In terms of what we look for and the process around contingent or specific risk insurance, the key for me has always been around the sound motivation of the parties. We very much, the driver for our insurance is not because people are worried about the claim itself or a claim materializing. It is that dynamic that I refer to, where the seller is very comfortable with that risk, and had it not been for this transaction, and it not been for the buyer's advisors maybe taking a different view or different opinion on a risk, that's what's driving the insurance. It's not a first party saying, I have an exposure on my balance sheet and I don't like it, so can I lay that off? As Dawn accurately says, the tax market is developing in that direction. And tax kind of, I suppose the one way to think of it as well, used to fall under this contingent bucket, in the sense it's the known part of the market. But tax has become such a mainstream product now that it kind of stands there in its own right. But a lot of the process, the dynamics, etc., that you look for on those tax risks are echoed in the remaining contingent risk known part of the market. The key point on the process that I draw your attention to is high quality advisors. I think because we're dealing with known issues, what is very key on our underwriting is getting high quality advisors with solid opinions. And we commonly look for those opinions to be of a should level. So it points to that risk remote nature of the risk, and kind of cements the view that the motivation of people seeking this insurance is not a concern over the risk itself, but it is because it's holding up this deal, and it is used as that deal facilitation tool. I'll touch on capacity very briefly, and also kind of what's going on in the market before I'll run through a few case studies to put some of this into context. In terms of capacity, it is a smaller part of the M&A insurance market. Not everyone has appetite for these risks, but you can still get together probably 300 to 400 million of capacity. That's kind of where it's topping out at the moment in the marketplace. So I think because these known issues are single one-off issues typically, that 300 to 400 million is to date been more than enough to cover off the issues. And on our book, the contingent risks are averaging around a 25 million limit. So they are typically single carrier issues, and those carriers are more than enough limit to deal with the single issues to facilitate the deal. And in terms of what's happening, Tim's right, and it's not going to be a surprise to everyone listening about the drop of inquiries in the marketplace at the moment. But for us, what has been holding up very well is the known part of our book. It's the tax and the contingent risks. We've seen quite an uptick in inquiries already, and I think that will continue. I think it happened post-financial crisis, and whilst you're 100% right, Adam, this is very different to the financial crisis. I think the kind of motivation for the people on the deal is very similar, and I think lenders will drive the use of insurance as they did previously, as their loan to values decrease, as the lending covenants tighten up. I think known issues on a deal that were once viewed to maybe be something that you could wear, people will now seek alternative solutions, because if they're able to borrow less on a transaction, or as I say, the lending criteria tightens up, maybe it's the credit committees at the banks that will drive this need for the insurance. And that's something we're seeing at the moment. We've got 2 contingent deals on the go at the moment where, strangely, both buyer and seller are very comfortable with the risks, and both their legal advisors are very comfortable with the risks. But it's the credit committee at the banks who are actually saying, but we're aware of this issue and we want it dealt with. And that's what's driving the need for insurance. So that's what I think will continue over the coming 12 to 18 months. To put something in context, so if I run through a couple of case studies that we've underwritten in recent times, the most common kind of known risk after tax is litigation. We're not, when I say litigation, it's kind of, we're not the what's referred to as the ATE market, the after the event insurance litigation market, where you are talking about a proper piece of litigation. Maybe it's a class action, and a party or a group of people are getting together to sue a claimant, and you're wanting defense cost coverage. The litigation that gets covered in our market naturally is connected to an M&A transaction, but it's often quite a spurious piece of litigation that may not be fully developed. But similar to how Dawn spoke about the tax insurance, it's something that is kind of clogging up a balance sheet. And therefore it prevents that deal from happening because the buyer's not sure where this piece of litigation is going. And some of the ones that we've done recently, we've had a private equity fund disposing of an engineering company that was being sold for a couple of $100 million. And during the deal process, a CEO who had only just left the business, definitely not voluntarily, bought a series of claims totaling 75 million, pretty much to frustrate the deal process, which he obviously knew what was it was being teed up just after his departure. And it was very easy to go through the heads of claim and work out in the underwriting that the whole claim was there to frustrate the deal process, but a lot of it was spurious. But that said, some of it did have groundings, and he definitely did have a cause for some of the claims. So what we did on that transaction was basically attach above where we thought the CEO probably had some merit to his claim. And to put it in context, we attached at a 5 million attachment point, but as his claims totaled 75 on a couple of $100 million deal, we took out the 70 million, which was the worst case scenario in which the buyer could then get comfortable and price the potential downside of that 5 million into the deal, and it helped facilitate that transaction. Other pieces of litigation that we've seen in the market place, we've seen them on renewable energy plants. Again, spurious piece of litigation where maybe neighbouring landowners are not happy with the next 100 acres being covered in solar panels. And this was one in Italy, actually, where those neighbouring landowners brought claims saying that the plant wasn't built within planning laws, wasn't approved, and should be pulled down. And it was again vexatious. And you could see that again in the heads of claim and as you went through your underwriting, because it's a process you can go through to identify, well, was it built within planning permissions, and have you done anything that's overstepped the mark? And so it's easy to see whether or not they're on the right side of the law. But nevertheless, that claim was out there where the claimants were going through the court process, and the potential outcome of that deal that they were claiming for was for the plant to be pulled down. This was one of the situations where the buyer was happy because through their due diligence, they'd taken comfort that the solar plant had been built correctly. And this was one of the banks behind the scenes saying, that may be fine for you, but for us to lend against this deal, we want this situation totally covered off. And so they placed a policy of insurance driven by the banks. Other situations we're seeing, that's on your list. We've got Section 75 risks in the UK, and I know there are issues that happen in other jurisdictions as well, where all to do with pensions underfunding. This is where you may have a pension scheme within a group company, and a subsidiary has historically been sold off. That wider group then has gone insolvent, and we've got one of these on the go at the moment, and it has been driven out of the current crisis. So the group is insolvent, and the risk is that the subsidiary that was once part of that group may end up being on the hook for the pension scheme. Again, in the UK, it's quite easy to go through the law and work out, well, were they a scheme employer? Were any of the subsidiaries' employees a beneficiary under that scheme? Has any wrongdoing happened with the management of that scheme? Have proceeds of sale been siphoned off? And basically, is there any reason why the pensions regulator is going to come looking at this now solvent subsidiary to top up the pension scheme of this now insolvent wider group? And again, so it's something you can underwrite. It's a legal trigger. And it's a trigger that can be easily defined in your underwriting that allows the insurers to take the risk off the table. And I think that's going to become more and more common. We've placed one recently on those pensions issues, and we've got another one on the go. Again, it's being driven by the banks. And on that one, the slight difference we're doing is because it's the banks driving it, rather than place a limit of insurance on the whole, the kind of total of the issue. What we're doing is we're going to amortize down along with the loan. So as that gets repaid and the bank is taken off risk, our policy will amortize down as well. And we're doing that really to keep the cost down for the parties on the deal, because obviously they're very comfortable with the issue, and probably buying insurance is not what they wanted to be doing on their transaction, but they obviously got to do it to get the bank comfortable. Quickly touching on a few others there, I won't go through them all. Orphan funds at the bottom, we've done quite a lot of those, and again, it's similar to how Dawn described some of the developments in the tax market. This is where money can be on a balance sheet, and it's effectively just clogging up that balance sheet. But because no one knows really where that should be going, neither the buyer or the seller can accurately deal with it in their transaction. And we've seen this with asset managers that were once custodians for certain clients. One asset manager in particular did an asset sale of their business, so they retained the company, and where they've been a custodian maybe on, again, this was a piece of litigation in the US, a class action. It took 8 years to settle. So 8 years later, the asset manager is now getting checks of settlement numbers, but they don't own the business anymore. They don't know where the clients are. They don't know where they've gone. They hired tracing agents. They hired detectives. They did a national advertising campaign to try and repatriate these funds. So they went to a lot of effort to do that, but they were still left with several $1 million on their balance sheet, which had to be cleared up and taken off the balance sheet, because the wider business was then going to get sold on a share sale, and the buyer wanted that issue cleared up. And we've seen that kind of issue happen in lots of different industries. We've seen it on a music business where it was copyright, and people weren't sure whether Adele's music played in Brazil, was it who should get the money? Was it the Brazilian radio station? Was it the copyright holder in Europe? And someone in the chain has decided it was the copyright holder in Europe, but the copyright holder in Europe actually thought it wasn't them that should be getting the money. So again, no one wanted this money. So it sits on the balance sheet. Where does it go? A buyer coming along to buy that music business needed the issue taken care of because they couldn't price it into their deal, and they didn't want to be paying for money that they didn't think was going to be lasting on their balance sheet. So again, insurance was able to come along and take that issue off the table. And then the final one I'd go through is just a quick contractual one, because I see this happening quite a lot, where this was a trading business. The trading house concerned had a number of contracts with a large investment bank. They terminated those contracts, and they terminated those contracts correctly, but the trading house coming up for sale have been put on notice by the investment bank that they weren't happy with the termination of those contracts, and they were going to seek recourse. So the buyer, in knowledge of that, was then left thinking, well, if they do have a claim, though, what are we going to do with this? Because the quantum that they were seeking equaled 25% of the deal value. So again, it's always those things that hold up the deal happening. And in that situation, again, it was very easy to see their legal advice on the deal. We then, in part of our underwriting, also take our own legal advice, and we were able to get very comfortable that the contracts had been terminated correctly, and therefore the claim coming from the investment bank concerned was vexatious again, and was much more about frustrating the sale process, because it was more tied up in commercial relationships than it was to do with the merits of the claim. So we were able to ring fence that issue and price it into the deal.
Okay, well, Richard, thank you very much for that. I think I'm just going to go very briefly for an overview, and then I'm going to ask Rob to just summarise with 3 key takeaways. But obviously, any future deal landscape will be substantially different, and meticulous planning now around structuring and executing deals should significantly increase the likelihood of a successful transaction. So, Rob, as I said, you've sat there so patiently. Could you please give to our audience, the 3 key takeaways from this morning's session?
Thanks, Adam, and thanks to my fellow panelists. Thanks for putting a topical event together, Adam, to try and draw it together. I think what sort of Tim, Adorn, and Richard have spoken about, hopefully it shows you now the sort of the growth and sophistication and diversity that's available in this market that wasn't there, frankly, 10 years ago. One of the big catalysts for change was the financial crisis and the challenges that people faced in the aftermath of that. So I think if I was to try and summarize it into 3 things for you as a takeaway, as Tim sort of talked you through sort of the synthetic warranty covers that are now available, and touched on distress scenarios. There's a fundamental protection there for insurance, that people are now sort of facing a dynamic where, yes, asset prices are lower, but there are probably more embedded risks in deals. There's probably less opportunity to do the level of due diligence that you'd hope to do in a slow, normal transaction, but the distress will speed up transactions. So whilst insurance isn't a replacement for due diligence, balance sheet protection and reassurance that the overall insurance add-on brings is quite valuable in an environment like this. And touching specifically on the distress deals, Tim gave you sort of a feel there how the insurance in quite a short period of time has grown from a take-up rate of sort of 6% to near 40%. What I say there is that probably the area that hasn't really been exploited yet, but I think there's a great opportunity to exploit it, is around the distress deals. The insolvency practitioners have had some involvement in the cover. Dawn touched on a large tax bill that was done with insolvency practitioner here, and already we're sort of seeing GP inquiries come through, accreditation risks, all sorts of one-off issues that are stopping these deals proceeding. So I think really the opportunity, and my final point, and sort of touching on the sophistication of the market, is that by tapping into sort of the experience and expertise, not only of advisors like who works very closely with the market, as you can see from the panel here, but but the sort of the knowledge within the insurers now, you can come up with solutions that fit these distress dynamics. So I think probably the key takeaway is rather than kind of leaving it till it's too late and there's nothing to salvage from the deal, is exploiting the insurance market in the right way, that you can actually bring financial value to these transactions in various forms. So I'd sort of kind of close off by saying really that have an open dialogue with underwriters through them who can introduce you to probably the sort of the most suitable underwriter for a particular inquiry, and through that dialogue you can not only can you sort of explain the issues to the marketplace, but also that can work with getting a solution that actually work that deal, because this isn't a market where products are off the shelf. They do get bespoke for a deal. So there's a great opportunity, and it's just it's the market and sort of make it sort of create something worthwhile.
Right. Thanks for that, Rob. I actually have just really one question, or two questions actually, as we're close to running out of time on this session. Firstly, Richard, when we were talking about specific specialist contingent risk insurance, is it worth sellers perhaps before they come to market, with regards to selling the company, if they've identified an issue, is to perhaps seek terms on that identified issue, which then effectively removes it from the transactional process and any hold-ups that might subsequently ensue, especially if we're having to move quickly in the current climate.
Yeah, absolutely. And to echo what Rob's just said, and also Dawn touched on it, we do see it quite a lot in our marketplace where, in terms of an underwriting process, we do dovetail with the underlying deal process, and insurance won't be holding up your transaction. And as a result, though, we'll move as quickly or slow as that transaction needs to move. So it's not uncommon that people will come to us knowing that their business is going to be put on the blocks in the coming months, and they know of this issue, and they want to take it off the table so that maybe our terms can go in the data room, so the buyers can see when they come across this spurious piece of litigation or whatever the issue is, an insurance solution is already being tabled, so it doesn't become too much of a distraction on the deal. And I think that's a sensible kind of bit of deal planning that can happen. And it does happen quite a lot, but to the extent it doesn't, that doesn't affect the insurance market. As I say, we will go as quickly as people need us to go. So if it is something that's actually, it's not that the seller is unaware of it, but probably doesn't view it as a risk, but the buyer's advisors take a different view, and it comes up at a much later stage in the deal process, then we'll deal with it then. But I think, as Rob was just saying, the sooner the better, because it allows us to come up with a more tailored solution early doors.
Okay. All right. Well, I mean, I think that's probably actually not only addressed the question that I'd asked, but the subsequent question as well. So I can't see that we've got anything necessary at the moment from any of those participants, but I'd like to thank you all for joining us.
Adam, sorry to interrupt. There is one. Whilst you were talking, I was reading the chats. There's a question here. It's probably a good one to sort of ask Tim to expand on, but the question is, the audience would be grateful to hear whether insurers would exclude liability for constructive knowledge of the buyers or the buyer's advisor. So this relates to synthetic warranty. So Tim was explaining the synthetic solution. So what would be asked is whether sort of the insurers exclude constructive knowledge there under the policy or the knowledge of their advisors. So if I can pass that on to you, Tim, that'd be brilliant.
Thanks, Rob. Make sure I don't get a double negative here. The way it would work is, to be honest, how it works under all W&I policies currently. The policy won't cover matters that are within the actual knowledge of the buyer's deal team. The deal team there is limited to the buyers, not their advisors. So in that sense, we're not looking to point to any knowledge of the advisors, particularly not constructive knowledge of the advisors on the buy side. So that isn't a carve out for us in the sense of, if there is some constructive knowledge in there, we're not going to point to that and not pay the claim. The way the warranty indemnity policy works, to be honest, is we try not to get into too much of a sort of Donald Rumsfeld of who knew what in terms of actual knowledge, and instead there's a tendency instead to point to just matters being disclosed against the policy. So on a synthetic deal, we would point to more the buyer's due diligence reports and any Q&A document that the buyer had the opportunity to do with the sellers. And if the issues are fairly disclosed in those documents, then they'll be outside the scope of cover under the policy. And in terms of what we mean by fairly disclosed, we would generally follow the English common law standard or the local law standard for that.
Okay. Right, well, thank you for that, Tim. Answer, and thank you to everybody for joining us today. I will follow up with a link to the recording and detailed Q&A, but please contact me with any additional questions or feedback. In the meantime, may I say thank you to the panelists for joining me today. Thank you for joining us as well, and stay safe and stay well, and I wish you all a good week. Thank you very much. Bye.
Thanks, Adam.
Thanks, everyone. Bye-bye.
Thank you.
Are you still on the go, or are you going to call them?